Lee Munson, Chief Investment Officer of Portfolio Wealth Advisors. Lee, you and I have had this conversation, and the truth is that, and I've been told this, if you try and pull your money out or try and time the market, you'll miss the best 10 days of the year. And then you're really stuck with some losers.
Oh, yeah. I mean, I was looking at missing the 5 best days. Forget about the 10. The 5 best days since the great financial crisis of 08-09. And you go from sort of an average return of, say, 14% on the S&P down to negative, almost 2%. So I think that, here's the thing. Everybody knows that if you're younger, if you have a 401k, you need to not touch it, and you just need to add to that stuff. The problem is that in our industry, we consider ourselves in the prediction business, even though the only 2 things that we never know are when something bad is going to happen and the magnitude. And I think that we all too often try to paint it in a binary issue of either you're trying to time the market and sidestep those couple days, or you're trying to avoid the down days. Now, here's the problem. If you also take out the 5 worst days, that average performance goes from 14% up to 34%, right? And so a lot of people hear that and they try to chase these great numbers. The problem is we never really know what those great days are. Think of how random the last 4 months have been when we've seen the market go up 5, 6, 7% in a day. So I think instead of looking at it from the extreme and thinking about pulling it all out or pulling it all in, I think that investors out there, and this is how I roll, is that you have to think of it in terms of what is a rational way to engage the timing of markets, right? Like rebalancing. If you have a balanced portfolio, is it okay to rebalance in March? Of course it is. Now, some might say, well, that's timing the market. I would say, that's not really what we're talking about. If you have a mixture of stocks and bonds or just international stocks versus the NASDAQ. I mean, the NASDAQ has been on fire this year. There's nothing wrong with just rebalancing down to a general allocation. I really don't consider that market timing. And so I think if the viewers get an idea of, yes, there's money to be made and lost by timing, but don't view it in such a black and white issue. Just find a way to be more moderate. And quite frankly, we all know one thing, people love to sell the most when the market is at its worst, and people tend to want to buy the most when the market's off its high. So I think just a little moderation.
Yeah, and I know you have time in the market. You have a chart time in the market versus timing the market. And this is what you're talking about with these 5 days, these stellar 5 days, like you have to be a part of it. Also long-term investing. We want to get to all these great things. So give us some fun facts about each of these charts.
So one thing that I love is when you start looking at, say, the S&P and trying to figure out the worst and the best day going back, many, many decades, you can almost double. So here's the problem. You can almost double your money, as you can see here, if you take out the worst month per year. But the problem is that for all that upside, if you take out the highest returning month, you basically flatten out. And here's what's so interesting about this. Everybody tends to just look at the upside of stepping away from the worst month. And I get that. We all feel that we're exceptional. We all feel that we're above average drivers, on the road. The problem is that when you think about the amount of upside you can make versus not making any money at all, then the wager starts becoming more clear. Because if you screw this up, Nicole, you're going to end up making no money at all. And if you have perfect timing, sure, you're going to make more money, but the odds are stacked against you. And statistically, we know that investors don't do that. The really cool thing, though, is if you have a more balanced portfolio, it's less extreme. So, most of my clients are retired. They have kind of a 60-40 mix between stocks and bonds. There's a lot less upside for a balanced portfolio to try to time the market than if somebody's all in stock. But again, just remember, look at these stats. Instead of looking at how much you can make if you could figure out how to sidestep the worst, people need to focus on how anemic your returns will be if you miss that one great month that in general, nobody ever sees coming.
Right, right. I love your passion, Lee Munson. You're so good at this. And I love when you're here. That makes it even better here on Market Overtime. Lee Munson, Chief Investment Officer, Portfolio Wealth Advisors. Thanks, Lee.